Hello and welcome to this weekly market recap for the week ending Wednesday, May 28th, 2025. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com. It's a pleasure to be with all of you again this week. We've got a little bit in store, a couple things in store for you today. I want to talk about a couple things that most traders, I think, tend to ignore when they look at the stock market, or maybe they just don't know to keep an eye on it. But I'll go over those two things in just a bit. I'm also going to go over a strategy that we use at EarningsBeats that will help enlighten you, I guess, as to some of the ways that we trade, some of the trading strategies that we have at EarningsBeats. I think you'll find that fascinating as well. But first, we're going to get into what happened over the course of this past week. Remember, I'm looking at action that has taken place from the close last Wednesday to the close this Wednesday. We're doing the recording on Wednesday evening. You're not watching this video until Thursday, so just keep in mind, I don't have any idea what's happening on Thursday. So if you take a look at this, remember, we're doing this as of Wednesday's close. Let's take a look at what happened in terms of the major indices over the course of the last week. The Russell 2000 and the NASDAQ 100 both up 1.13%. But you can see if you go through the list all the way down to the mid cap, which is up roughly about a little bit more than half of 1%. All of the major indices have kind of been, pretty close together in terms of performance over the last week. We continue to move higher, continuing to try to push and find new all-time highs. We got a little ways to go to do that, but it's not as far off in the distance as we might think. Overall, though, pretty good week from Wednesday's close on the 21st through Wednesday, the 28th. Looking at the sectors, consumer discretionary leading, gaining more than 1.5%. Then we had real estate, 1.3%, communication services, industrials, technology. Then comes the S&P 500. So as you look at this, you can see 5 groups beating the S&P 500, and 4 of them were our aggressive groups. So we're not seeing really any kind of a reversal off of this risk on type of market environment. And that's good for the market. We want to see that risk on. And that's what we've seen over the last week. And that's really what we've seen off of the April 7th low. So all of this good news. To the downside, you can see utilities and energy, by far the 2 worst groups last week. But again, that's really doesn't bother me. I like to see these aggressive groups, particularly technology, consumer discretionary, and communication services. I like to see those 3 groups doing well. All 3 outperformed the S&P 500 last week. Moving on to the 10-year Treasury yield. I know I'm just bringing this up for perspective because there's a couple of things that I think most traders ignore. One is perspective. You get so caught up in what's going on just in the course of the latest month or a few months where we've had a lot of headline news that you can't really seem to back off of a chart and look at the long-term perspective. Now, I remember back in 2022, we were all being told, well, rates are shooting higher. We've got inflation. The market can't go any higher. Now, back in October of 2022, when we did see the market bottom, notice that the 10-year Treasury yield at that point was up at around 4.5%. And we have kept, and everybody thought that was horrible. Rates were at 4.5%. And, we were used to free money down near zero. And I kept saying back at that time, 4.5% is not a bad rate when you look long term. This is just over the last 5 years. But if you go back 50 years, 4.5% has been a very, very solid rate, and is certainly one that is conducive to our GDP continuing to grow. And I wanted to point this chart out because I think it makes a lot of sense to me. We are still sitting at about 4.5%. This is 2.5 years later, maybe a little bit more than 2.5 years later. But look at what the S&P 500 has done. Think back to where you were in October of 2022 and what you felt about the stock market. The S&P 500, which got down to 3491, I think at the low, that was the intraday low, 3491. And now we're back up not far from all-time highs, sitting near 5,900. 3491 to 5,900, that's about 70% increase in the market, while we have effectively been sitting in this 4.5% range. So when folks are talking to you about interest rates and you're seeing headlines about interest rates being too high and so forth. Just think back what we've done over the last 2.5 years with rates being at this level. Next up, I always like to go back to this chart. This is a long-term, well, relatively long-term chart of the S&P 500. This goes back since the turn of the century, so about 25 years. And what I've done is I've drawn channel lines to show how we've traded over the last 16 years since putting in that bottom with the financial crisis back in March 2009, connecting the two key lows, financial crisis and the pandemic, and using that same slope to connect the highs, which it does connect many of them. But one thing to note is that each time we get up to or maybe just above the upper channel line, the market has a pretty significant pullback, either a correction or a cyclical bear market. That's what we have seen just about every time we've gotten to the upper channel line. So this was 2011. Here was 2015 after we tried to pierce through that upper channel line a number of times between about the middle of 2014 and early 2015. And then finally, we had a correction that took us back to the center line. Also, beginning of 2018, we tested that upper channel line, failed. In 2021, late 2021, second half of 2021, you can see we went outside the channel to the upside. And this was one of the big reasons why, along with sentiment, why I thought the market could have a pretty significant decline in the first half of 2022. Called that before we ever saw the market go back down. But you can see almost every one of these, except for that very panicked low with the pandemic, almost every one of these pullbacks off of the upper channel line have held right around this center line, this blue dotted center line coming up in the middle of this channel. We started 2025, and I was thinking we were probably going to see a correction. I didn't really think we would see a cyclical bear market, but we were at the top of the channel, and that was one of the things that bothered me going into 2025, is I felt like we might need some time to go sideways for a while and allow this center blue dotted line to come up and meet price action. So I thought maybe we would do that somewhere around the 5,500 level. From what I recall, that's what I was looking at back at the beginning of 2025. Instead of this slow correction, we instead had a very swift cyclical bear market. But look at where we bounced, right off of that center line again. And now here we come right back up toward the highs. And that's been the history of the market. When we go down and we hit this blue line, the blue dotted line, for the most part, we are setting lows that we don't go back and retest. And that's one reason why I don't believe we're going back to test the lows that we saw back in early April. Again, using 15, 16-year channel as perspective. It's a lot easier looking back at this, but when you anticipate it ahead of time, then you're not shocked and you don't get spooked by the market when we do see these pullbacks. So again, just another chart that I think keeps perspective in mind. Now I'm going to keep going because one other thing I think that traders tend to ignore or maybe look at other indicators when they're thinking about sentiment. I like to use a couple of different charts when I consider sentiment. And sentiment, especially when you look at the big picture, can provide us invaluable insight into not only where the market's been, but where it's likely going. And so down here on the bottom, I have a 253-day moving average of the equity-only put-call ratio. That's a year's worth of readings. Now, the reason I do that is because I believe that the long-term sentiment helps to influence the direction of the market. And so when I started this study, I wanted to see what kind of impact this would have. And what I found is this: whenever the 253-day moving average is bottoming and starting to reverse back to the upside, that's when fear starts to pick up and the market doesn't do as well. When we go from a market that's very complacent to one that's very fearful, that process normally takes a toll on the S&P 500. The flip side, though, is that when you get to a point of extreme pessimism and fear, and you start to roll over on this 253-day moving average of the equity-only put-call ratio, that normally starts a very, very bullish period for equities. So take a look at this. I mean, I'm not making this up. I'm showing you exactly what's happened. Here's the 253-day moving average at the bottom, and here's the S&P 500. When we are rising, when we turn higher and start rising, here, S&P 500 dropped 48.6%. That was leading up to the financial crisis. But then the financial crisis had us so bearish, we didn't think the market could ever go up again. That's when the market bottoms. So we topped there, rolled over, and while we were moving down, the S&P 500 in 2 years went up 95%. And then it's just simply rinse and repeat. You go down. Well, here we went back up for a while. Market went almost nowhere. Then we were very fearful or more fearful. We rolled over, started moving lower again. The market goes up 54% in a couple of years. Then fear starts to build again. And while it's building, the market goes nowhere. And then we get fear at the top. It starts to roll over. And when it does, S&P 500 makes another run. Then again, we go through this choppy period in 2019 into 2020, which essentially we had a choppy market as well, but we didn't go anywhere. Then look at this move to the downside. That coincided with a pretty big move up in the S&P 500. And it was right here at the beginning of 2022 when this started to curl up and was making about a 6, maybe even a 9-month high. That's one of the reasons I pointed out at the beginning of 2022 that I thought we were going to have a pretty significant decline, a cyclical bear market that I thought within 6 months could take us down as much as 20 to 25%. I think we ended up going down 23% or something by the June low. And that was most of the weakness. But this whole move back up right here during all this pessimism is when we saw the market go through a very rough period. Once we rolled back over again in 2023, it's been lights out again to the upside. Anyway, I just wanted to point that out because I think sentiment and perspective are two things that just are not thought about enough in your investing. You get so caught up again in the short-term action of the market, short-term headlines, what folks are saying. And it seems like bad news just keeps piling on. And unfortunately, a lot of times the market just puts its head down and just continues to power through that. And I think that's really what we've been looking at since 2023 began. The other sentiment thing I wanted to point out here was the University of Michigan consumer sentiment. This is one that has a pretty good long-term track record. This goes back 50 years. This is a chart that goes back 50 years. And these green dotted vertical lines right here all mark readings on the consumer sentiment, the University of Michigan consumer sentiment, that is at 65 or lower, meaning consumer sentiment was horrible. Folks did not like what was going on. They felt like the economy was horrible. Maybe it was jobs, but whatever it was, the readings were coming in very low. Now, I want you to take a look at where this coincides on the S&P 500. Right here, beginning of 1980. Again, a couple years later, beginning of 1982. Look at what happened after those readings. How about this low in 1990? That was the Persian Gulf War, when the sentiment dipped back below 65. If you got in right when we went below 65, market explodes to the upside. Other green lines here, right before the financial crisis bottom. It came in a little early. We had a couple of different readings in here, by the way. But we bottomed, market took back off again. 2011 was a little aftershock where the market went back down. You can see consumer sentiment also went back down, put in a low around 56. That was a great time to buy. And then more recently, when you looked back to June of 2022, we had the lowest reading in 50 years. That coincided almost with the bottom to a T. We ended up going down just a little bit lower in October of that year. But if you had gotten in June of 2022, that was perfect timing. And that was when consumer sentiment was at its worst. Look at where we are right now. Consumer sentiment still sitting down around 50. And the market actually has already been rebounding, but we still have sentiment that is so poor that, in my opinion, it's going to drive us right back to all-time highs. But again, perspective, sentiment, these are two things you've got to keep on your kind of your watch list if you're evaluating the stock market. A healthy dose of each one of those, I think, will help you call the market a little bit better and help you get through some of these really bearish periods that we go through from time to time. All right, I want to mention that if you go over to EarningsBeats.com and scroll down, we have our free newsletter. It's our Earnings Beats newsletter. All you need to do is put in your name, email address, hit that subscribe button, and you're good to go. We deliver those articles Mondays and Wednesdays before the market opens, generally speaking, assuming I get it done in time. But that's what we try to get out there. If you look on your screen, you've got an opportunity to use your mobile device to scan the QR code, which will take you to a landing page where you can sign up on your mobile device as well. I'm going to give you a bonus, though. Anybody who signs up on Monday, when we do our next Earnings Beats Digest, I'm going to have a chart list that you can take a look at that's going to provide you some of the best stocks to trade or to consider trading. And I'll show you what I mean here in just a minute. Before I get into that, though, I do want to pull up Nvidia. Nvidia came out after hours today with its earnings. Of course, this is big, big news. The stock is up 4.5% after hours. It was up probably another 2%, probably about 2%. I think it was up a little over 143 earlier, but still up nicely, providing futures a lift after hours. It looks like the QQQ get off to a pretty nice start tomorrow, assuming that not a whole lot changes overnight. But I wanted to mention NVIDIA. There was one other report that came out that was very strong as well. Veeva Systems, stock up 15.7% after hours. That's in the software space. So a really good report on Veeva. All right, so let's take a look at this list. So what I like to keep, what I like to trade anyway, are stocks that are leading stocks in their industries, which are also leading industries. So if you can get a stock that is strong within its peer group, and that peer group is strong relative to the S&P 500, you are going to find it much easier to outperform the S&P 500. These stocks tend to lead for a while. And as long as they're showing relative strength, I would continue to, consider holding them. But what I have here, there are 47 stocks on this list. And what I've done, we have a chart list over at EarningsBeats that has all of the industry groups relative to the S&P 500. So I can point out which are the strongest groups. I can find the best 10 or 12. I put them into a scan and I run them against our strong earnings chart list and our raised guidance chart list. And I also look for scooters, the Stockcharts technical rank, to be above 90. So these stocks that are on this list are set up beautifully going forward because they are leaders. They're within, the scooter score tells you they're leaders. Their groups are leaders because I can see it on the chart when I look at it relative to the S&P 500, showing outperformance. The stocks are coming from chart lists that we've already vetted at EarningsBeats for strong fundamentals in terms of beating revenues and earnings per share in the most recent quarter, and then also potentially raising guidance. So these are stocks that I certainly would think are among the best to trade. There are 47 of them. And what I did and what I want to show you on this next list is here are the 47 stocks along with the S&P 500 that I put on here. And I want to show you how these stocks have done over the last week. So best one has been Advanced Auto Parts, jumping 68%. But there are a couple others, 49, 34, 21, 16, 14. And that occurs with the S&P 500 down here near the bottom, rising 0.75% over the last week. There are only 7 stocks on this list that underperformed the S&P 500 this week. So in other words, if you're trading these stocks, unless you just happen to be really unlucky and just are picking among the 7 that are underperforming the S&P 500, if you're trading stocks on this list, it's hard to underperform the S&P 500. And I want to go back and show you these same stocks over the last month and look at these returns: 138%, 100%, 70, 68, 68, 61. I mean, these are stocks just in the last month. Now, the market's had a great run, but let's look at where the S&P 500 is on this list. Out of 47 stocks, 46 of them have beaten the S&P 500 over the last 30 days. Only one has underperformed, and it actually gained ground, but it's been a slight underperformer to the S&P 500. So this is a very, very strong list. And what I want to do for anybody who signs up for our Earnings Beats Digest between now and Sunday, I will put a link into our EB Digest next Monday morning where you can download the list. I will update it through this Friday. So once we get through this week, I'll redo the whole process, making sure I have the best industry groups. Look, and then I'll search for the best stocks within those industry groups. And whatever comes up on that list, I'll hand it to you next Monday. So make sure that you sign up for our Earnings Beats Digest newsletter. It's completely free, by the way. No credit card required. You can unsubscribe at any time. But check that out. All right, that's basically a wrap for me. I really appreciate everybody, tuning in again. I think the market continues to be poised to go higher. We'll see how much higher here over the next couple of weeks to a month or so. But the last 10 years, May, June, and July have been it's been the best three consecutive month period for the S&P 500 over the last 10 years. So forget about all that go away in May talk. I'm telling you, May, June, July have been strong. It's set up right now to be strong. We're trending higher, and I think we continue to go higher. So I'll be back next Thursday or Wednesday for the next show. Make sure you like the video here and also subscribe to the Stockcharts channel. I'm sure they would appreciate that as they build their YouTube community. Have a great day, everybody, and happy trading.